Hello, everybody. Welcome to our webinar. And we have Sean Caldwell here. He's going to be talking in a couple minutes regarding oil and gas royalties in a 1031 exchange and how they could potentially benefit you guys. Give us a couple minutes. We're going to make sure everybody gets in before we start. Okay, let's get this started. Sean Caldwell is a friend of mine. He works for Montego Minerals, which is the preeminent oil and gas royalty deal in the DST space. They are direct ownership interest, but they can function as a fractional institutional quality real estate asset for a 1031. Similar to a DST, but in a direct ownership position. Sean, if you'd like, I'm going to hand the wheel over to you. Introduce you, Sean Caldwell. Take the wheel.
Yeah, you bet. No, I appreciate you, Mark, and obviously appreciate everyone's time that's able to be here today. And I'm going to do my best to make use of everyone's time by kind of moving through these slides in a way that if you have questions, we're going to take some of those at the end. So please, write them down or make note of a question you might have that's from a slide that you see here at the beginning of the presentation. But the way I like to start off introducing Montego Minerals is we're an energy company that does not drill, right? That's a bit counterintuitive when you think about oil and gas or think about energy investments. We typically imagine, a well actually being drilled, oil and gas being produced there, and a return being generated. Where at Montego, we are the hokey example is a Beverly Hillbilly. So we're the landowner, the subsurface mineral owner, where we're getting royalties as oil and gas is being pumped on the properties. And so we're going to go through that. I'm going to break that down here in just a bit using some illustrations. This is just a little bit on myself. You're seeing me here through the camera, but it's my 15th year in the space, all on the mineral side. I've worked for some of the largest buyers in the business over the years. Been with Montego now coming up on 7 years. We are a very unique company in the space in that we are a 3-generation family-owned business, that being Montego Minerals. And I'm going to kind of explain who we are in just a few slides. But the objectives, what I would imagine the objectives of this call for those listening are several bullet points you see here. I think the most important to take away here is the second bullet point. And that's that royalties and minerals, synonymous, is a widely held asset. It's just very much rarely owned by the retail investor. So it's institutional owners, it's the wealthiest families and endowments, churches, museums, so on and so forth, own this asset in a very large footprint. And so what Montego does as a company and as a family office is bring access to a largely inaccessible asset class to the retail investor. So a little bit about Montego. We're primarily based in we're headquartered in the Midland Basin. We're headquartered in Midland, Texas. That's West Texas. Our ownership is comprised of petroleum engineers and geologists, master petroleum engineer and geologist. That would be Rhett Gist, one of our owners, the second generation family member. So we're not a small company. We've got 260 million in assets under management. This year we'll deliver, actually it's going to be more. This slide hasn't aged well. A little more than 30 million in royalty payments on those assets. And actually we're approaching 1,200 unique investors, many of whom have repeat invested in our portfolios. So just a little bit more on the family. I think it's vital to understand who is the manager, who's out here acquiring this real estate, because minerals and royalties are thousands of feet beneath the surface, right? We can't walk into these buildings and make an assessment using our eyes on the value. Instead, we need that geological experience, and that's what Montego and the ownership bring to the table here through 3 generations of geologic and engineering experience. And you're seeing that on your screen. Monty Gist, the first generation owner at Montego, moved to Midland in 1956. He was a geologist at Exxon. Rhett Gist, really our CEO, master petroleum engineer and geologist, currently working with the company. Monty not currently working with the company. He's 93 this year. But Rhett's son, Cutler Gist, he's our COO, is an engineer as well from Texas Tech. But Rhett met his wife Janice Gist there in at Texas A&M. They moved back to Midland shortly after college, and they started Montego Minerals. And so, look, this family has drilled and operated wells. When you're investing in oil and gas, and certainly if you live in Midland, you have the opportunity to participate in the entire spectrum of energy opportunities. So they drilled, they've operated wells, but it was in '97 that they exited operating properties and just went into full-time minerals. And that was just a way that they de-risked their personal capital in a way that allowed them to stay in the energy patch, but not take on all those risks associated with drilling. And that's what royalties bring your portfolio. And so in the early 2000s, partnered with a few private equity-backed groups, a few of which are now public companies. We worked with them through about 2007, parked away from those relationships and just went full time into acquisitions on with our personal capital. But it was in 2013 that we started working with retail investors. And the reason we did that at that time, you'd have to rewind your mind back into what was going on in 2013. And it was kind of started pre-2013, but there was a boom. There was a shale boom that took place in our country. There was far more opportunity available for the Gists, the owners of Montego, than their personal capital could acquire. So we put together funds, offerings, both limited partnership structures and now 1031 eligible offerings that allowed investors like yourself to participate in a way that was direct ownership, again, 1031 eligible, but also allowed the Gist owners to expand their footprint. So that was why they wanted to work with retail investors, allowing them to bring access, but also expanding their ability to own this real estate generationally. Here's a picture of our company. I got Rhett Gist here in the middle, Cutler, Janice, got myself here, and a full team, as you see, investor relations, attorneys, division order analysts, engineers, so on and so forth. So just a highly skilled team, one that's, works tirelessly on these assets each and every day, each and every week and month to distribute millions and millions in royalties out to our many, many investors. This is our footprint, a sizable footprint. 80% of our assets are located here in West Texas. We've had 14 strategic liquidity events, and we're going to talk a little bit about that, which is to say this asset does have principal protection tools about it characteristically. And Montego recognizes that these are financial assets. And so while minerals and royalties are largely generationally held and not sold, they are sold when it comes to how we manage these assets. We like to see them improve in value as new wells are drilled. And at that time, we look to exit the real estate. So taking a step back here, let's just examine this asset class. So what are mineral rights? And you're seeing it right here. It's the ownership that is below the surface, right? So imagine any amount of mineral rights, gold, silver, water, hydrocarbons, so on and so forth. That is what we are acquiring at Montego, and that's what our portfolios are comprised of. So I want to separate the two different types of real estate that we're familiar with, that being surface real estate, right? Brick and mortar, farmland, so on and so forth, possessory property. With Montego in our portfolios, our investors own no surface real estate. You have no surface real estate risks. You have no taxes associated with surface real estate, and you have no rewards with surface real estate. What we own are the subsurface minerals, and these are deeded and titled the exact same. So subsurface mineral deed and the surface real estate deed look identical. They're just bifurcated from one another. So you can be the farmer and not the mineral owner. Many decades back, you saw that the farmer and the rancher were the mineral owner together. But over time, you've seen that these assets have been bifurcated as properties have been sold off, estates have been transitioned through families. And so the mineral rights do not necessarily have to contain or sustain with the surface deed. So again, we're the mineral owner. Now, just as important as what we do is what we don't do. So we're not a working interest investor. Montego Minerals and our investors have no working interest risks. We are just the mineral owner. We're the Beverly Hillbilly, as another example I mentioned earlier. Here are some operators. You're seeing Shell, Chevron, Exxon. These are just great examples. These are operators we want to own minerals underneath. And what they're doing is drilling and operating a well, right? They're taking on 100% of the risk for the lion's share of the revenue. And we are getting a percentage of all of the production that comes out of the ground, we're taking on zero drilling risk. We're taking on no capital calls. I think this is highly important, and that's that we're paid off the gross. So in 2020, as a way of example, within our portfolio, the lowest annualized return in 2020 was a 3.29% annualized return. So in a pretty disastrous year for oil and gas production and prices together, if you were owning the working interest side of the ledger, you were probably having to put money in to keep the operations moving. Whereas a royalty owner, we were free and clear of any of those expenses and risks, and we were just getting that free cash flow off of the production that was still coming out of ground. And it's a hard asset. This is an asset that carries no debt. You can own it free. You're owning it free and clear, and you can hold it for perpetuity. You can carry it down to your children and their grandchildren, because these are assets that aren't necessarily declining. These are assets that have production today that in that instance, yes, are declining, but you have additional room for new wells to be drilled. And I'm going to give you some illustrations here that show how new wells are drilled on this real estate. So this is the split. I talked about 70 or about the lion's share of the revenue going to the operator, and that's what you see here. So 75 cents of every dollar is going to go to that working interest owner, Shell, Chevron, so on and so forth. 25 cents is going to go to the royalty owner. And that's an improvement over the years. It was about an eighth royalty just about 10 years ago, with kind of common lease that mineral owners would sign with operators. And as technology has improved, that royalty percentage has improved as well. So, and again, just kind of speeding through this presentation. I hope that, if there are questions, you're taking them down. But again, in the essence of time, I just want to make sure I get these points across, and we'll certainly get questions here towards the end. But this is the advantage of owning this real estate, both in a 1031 or in cash. A lot of our investors at Montego are just cash investors, because you can do a 1031 on the way out. We can certainly talk about that today as well. But the advantage is that operators in these locations where we acquire real estate, that being the Permian Basin, Wyoming, East Texas, Louisiana, these are locations where operators don't drill one well, two wells, five wells. They'll drill dozens and dozens of wells across this real estate, because much like a wedding cake where you have multiple layers of icing, as an analogy here and an illustration for your mind, oil and gas deposits exist very similarly. So you have different zones where productive and proven oil and gas is in place, and only today are they producing about 20 to 30% of the ultimate recoverable reserves in place. And so operators build substantial surface infrastructure to both capture, contain, and then move to the market this oil and gas. And so they steadily come atop this real estate, and they add wells over time, sometimes 10, 15 wells at a time. And then occasionally they'll come back and add one well and another well. And we get that accretive growth, both in our income and the value of the real estate over time. And so this is just a look at some of our portfolios. Some of these numbers are going to change this month. We've had quite a few new wells drilled in February that are coming online in March. But the point here is you're seeing that percentage increase. And Mark, just to let the guests know, this is a client approved presentation. So, you don't have to scribble these numbers down if you're trying, or otherwise we can get this presentation over and you can look at these numbers more specifically. But the point being is all of our real estate, young and old, continue to see new development, to see new wells added to the real estate. And I think what's important here is that these wells are being added by those operators at zero cost to you, at zero cost to Montego Minerals investors in any of our offerings. So it's one of those highly exclusive and unique asset classes out there where an operator comes atop the property and adds hundreds of millions, in a lot of cases, billions of dollars in capital expenditures to improve the real estate, to grow their production, no cost to us, and we get all of that benefit. I always use the example of imagining we own a 5-story building, and the tenants come in and they add 4 more floors at no cost to us, but we get the improvement in the square footage and we get the improvement in the rent. And what's unique about this asset class too, you might be thinking, well, why doesn't everyone own this? And I kind of go back to that second bullet point on that second slide, which is this is a very widely held asset. It's just one that is not often sold. And so Montego does a great job of getting out, boots on the ground, working these county courthouses, having a call center, mailers, finding mineral owners that are willing to sell. And so any number of our portfolios make up those type of individuals that were willing to sell their royalties. So this is our past performance. I don't want to spend a whole lot of time here. I think our returns are admirable, but we have a sheet, Mark, that we can distribute to those that are here today that shows you all these returns. So we offer non-1031 eligible offerings. Those are fund structured. So you have a GP and an LP. I know we're here to talk about the 1031 offerings. They're just structurally different, but the assets are the same. And so just to back up real quickly, I hit the button a little quick. You can see really the value of a royalty property as it ages, right? Because as an asset ages, you have more wells being added, and you're seeing the vintage of these portfolios, just kind of looking at the first three, 2013, 2014, and 16, and you're seeing the lifetime returns and the annualized average. These portfolios are still cash flowing right now. We've had multiple exits in these portfolios. I'm going to show you those here in a moment. And that's calculated and does improve these annualized averages and lifetime returns. Because as assets have new wells drilled, we have the opportunity as an owner to say, let's take the cash flow, or you know what, better yet, let's sell the asset, because the value that we're getting from the market offering to purchase us is better than the cash flows will come off of in about a 5-year period. So it's really just an engineering and economic report that dictates that decision. So here's our 1031 eligible portfolios. You'll notice that one says in pay, one says not fully in pay. What's really a great characteristic of these assets is that we're building a very large portfolio of assets. And I'm going to show you our current offering here in just a moment. And you'll see that that offering has almost 90,000 acres. And so what Montego does on behalf of our investors is we deed you directly into this real estate. So at the county courthouse level, you could call and request a copy of the deed in these specific lands, and you would see your entity deeded and titled on that land. And that takes time. It's typically about 30 to 60 days after your investments come in or are funded. And then distributions take place because the operator has to verify. They're going to verify at the county level that you are the owner, and others, of course. And then they put you in pay. So they actually start releasing the royalties. In the interim, while they're not being paid, they're held in suspense. And then once they are in pay, you get that lump sum in that first distribution. And of course, we can talk a little bit about that, maybe Mark, on another call with clients that may want to schedule an additional discussion. But royalties really live in that 7 to 9, 8 to 10% cash on cash return range. There's a story around all of these portfolios and the returns. Just to kind of point out, like White Pine, this is almost a 90% natural gas portfolio. If you're paying attention to where gas prices are right now, we've felt for many years, even since 2019, that gas prices only until really the 2022 and a little bit into 2023, we saw natural gas prices go parabolic due to a fear of Europe freezing over, so on and so forth. But we have a couple oil assets in White Pine that we're in the process of exiting right now. But in general, you're seeing the returns here. And we do believe that royalties, it is an 8 to 10% cash on cash return pre-tax. There are tax advantages here. We're going to talk about those in a moment. This is an exit that I was talking about in White Pine that we're selling. We purchased this real estate for about $11,000 an acre. This is the one that's White Pine and Pecos that we're selling out of. And we've got an offer that we're exiting it at $40,000 an acre. So there's kind of a bit of an idea there on how we look to exit this real estate. So you're seeing some of those here, just to kind of separate some of maybe the confusion and fog here. With respect to our portfolios, we're not going to sell the 100% of one portfolio at a time. While it's possible that we would do that, it's more than likely that we're going to exit, as you're seeing here, like Fund 1 sold 10% of its Permian assets for 3.3x. So we look to sell the asset down in a way that we can sell, let's say, 30% of a portfolio for 100% of the portfolio's price, right? So if you had $100,000 investment, we're looking to sell about 30% of the assets for, say, 100% of what you invested, while continuing to receive income and continuing to have exits in the future. But we look to do that over the first 5 to 7 years of owning this real estate, which that time frame is what allows those new wells to be drilled we talked about in prior slides. So this is just a look at 9 of our exits. None of our exits, I mentioned we have 14, so there's 5 here not mentioned, all of which have been multiples of 2x or better. So none of those exits have been less than the original price of the asset. So solutions for all investors, this is direct ownership portfolios. Cedar Ranch, this is the asset that we have available in the market today. You're getting just a little bit of the investment profile here, so you can read this as I kind of say it out loud. But yeah, I mentioned it's almost 90,000 acres. So 87,000 acres, it's across 14 counties. You're going to see those here in just a moment. 81 properties, 12 operators, hundreds of producing wells. There's actually now 14 active permits, 62 DUCs, and room for an additional 184 wells. So this is just a massive footprint that you have the opportunity. And I find this, and Mark and I talk about this a lot, what makes Montego additionally valuable to any exchange that you might have is Cedar Ranch is considered one property from an identification standpoint. So whether you do the 200% rule, the 3 property rule, the 95% rule, if you're looking at the 3 property rule, this is one property, that being Cedar Ranch, albeit having 81 individual assets within. It's a $15.7 million offering. Mark knows this. We've got roughly 8 million, a little more than 8 million already in here. So this offering is open, it's moving, and that's largely how our portfolios kind of come to market. It takes about 60, 65, 70 calendar days before the equity is largely taken and funded. The minimum investment's $100,000 for 1031 dollars. If you're a cash investor, we allow $50,000 minimums there. Investor controlled liquidity. There is no debt on this real estate. So just a little bit of a look at the portfolio kind of footprint. And again, there's a basket of materials that you can go through to get even closer to these assets, that being in the PPM and the brochure, the 1031 ID language, so on and so forth. But just at a glance, you're seeing the locations of these counties. So you have the Permian Basin here, you have the Powder River Basin in Wyoming, you have the Haynesville Shale that actually expands in East Texas and Louisiana. So those are the 14 counties. Again, 462 wells. We love the Permian Basin. It's the most productive oil field in the world by volume. It's going to power the growth of and the need for oil and gas supplies on a global demand basis for the next many decades. So it's a store of value. Again, our headquarters are in Midland. We have roots in Midland, relationships that allow us to see inventory and real estate that just does not get outside the county. And that's what brings, again, a great level of value to our investors within our portfolios. What we love about Wyoming, that being the Powder River Basin, is the best operators in our country, the most capitalized operators that are trading on the stock exchanges, have been since 2014 amassing very large leaseholds in these areas. We started a buying opportunity up here many years ago, and we've accumulated a very nice footprint that is contained here in the Cedar Ranch portfolio. But what we love about the formation is, as I detailed earlier, when you imagine that wedding cake and you imagine those different layers of icing, well, the Permian Basin has anywhere from 8 to even up to 12 recoverable zones that are proven, not all producing yet. What's great about Wyoming and the Powder River is it has 6 recoverable zones. Right now, they're really largely producing 2 of those. So there's substantial additional development to take place in these areas over time, both bringing additional income and additional value to the real estate over time. So what we also love about East Texas and why we build a basket of assets that aren't just contained in one basin or one property, one operator, is that the Haynesville is a pure natural gas field. And when you look at natural gas right now, we say, it stinks, but we love it. We love it because we're able to get into this real estate at such a low cost relative to the future price of this commodity. Natural gas is a locally priced commodity, right? When you look at Europe and you look at Asia and the price that they're paying for the exact same molecule, they're paying anywhere from 4 to 5 times what we're paying, in some cases more. And so right now we have a largely trapped commodity. But the expansion of LNG that's going to happen later this year and into 2025 is going to allow the utilities, well, it's going to take the utility companies in our country bidding against the economies of these other countries that are trying to get lower priced contracts. So that's going to, and fully expect it to, drive the floor of natural gas prices higher. How high? It's hard to say. We think that we could see anywhere from $3 to $4 an MCF as kind of a steady floor there. And these operators are highly profitable, even at $3 an MCF, even at $2.50 an MCF. And what we love about Haynesville, maybe differently than the Marcellus, which you'd see up in Pennsylvania, even West Virginia, Ohio, is that it's proximal to this LNG. So you talk about transportation costs. There's a lot of intention in the acquisitions that Montego makes in any number of portfolios. And what we love about East Texas is the cost basis, the location, and the operators are highly capitalized. This is just a look at 3 different properties at a glance. I'll kind of jump through this. You can see this in our brochure if you request materials from Mark, just to kind of jump ahead a little bit and kind of round out the presentation with the tax advantages. And I like to say that this presentation could start with the tax advantages at the beginning. They are quite powerful. Now, for our clients that have 1031 exchanges, if you have no basis, right? If you've exchanged, you've sold an asset, you've depleted the basis to 0, you would use this tax advantage percentage depletion. So it's a perpetuity tax regardless of your basis, where 15 cents of every dollar is going to be tax-free. The other 85 cents is going to be taxed at your ordinary income. So a very generic tax tool that we don't see going away, as the government is our largest mineral owner in the country. Now, the other tax tool that you would get, now, if you have a basis on your exchange coming in, you're going to use cost depletion. I mentioned earlier that we have a lot of cash investors at Montego. And the reason you see that, not only just for the value of owning this real estate, but the cost depletion when you're a cash investor is going to be powerful in a way that you'll shelter. It says 50 to 100%. In the first 3 to 5 years, you're going to be closer to that 100% level. So on a tax equivalent return basis, if we're delivering an 8 to a 10% pre-tax, you're looking at a 12, 13, maybe even up to a 15% tax equivalent return using cost depletion. This is free to our investors. So Montego, I mentioned, we're geologists, we're engineers by trade. We also own 5% of all of the real estate that our investors own alongside you. So we want to protect our income from taxes. We feel the same way about Uncle Sam as everyone else. And what we do is we share and pass on this cost depletion report to our investors. It's highly intuitive. It's very friendly in the way that CPAs can digest the information and protect your annual income from taxes. So, Mark, that is it for this presentation. I know there are a handful of questions in here. We can open those up, I think, and kind of go from there. What are your thoughts?
Sure, that sounds good. I just posted my contact information, so if anybody wants a copy of this, email me and I can send you a copy. First question I have for you, though, I have one for you, Sean. Do you personally have an interest in any of these offerings?
Well, that's a layup. Yes, I do. I own and invest in each and every one of these offerings. You can see me here on the screen. I'm 36-year-old. I'm a fairly young man. I see the value. I have the advantage of being kind of in the kitchen per se on how we're sourcing and buying this value from other owners, packaging into these portfolios. And I know you and I have talked about kind of the impact that this asset has had both on my cash flow and just my financial stability from it. I want to continue to own this real estate going forward. Cedar Ranch is no different. I'll be taking a piece of ownership into this portfolio. And I just think it's one of the best asset classes out there. And it's one that has no MLS system, right? There's no Zillow, there's no large aggregator in software and technology that allows investors or owners, I should say, of mineral rights to just go and put it up for sale. And by that correlation, you have a lack of education and understanding about what is owned. And so Montego can come in and we can be that educator, but we like to be the buyer first, right? That's how these portfolios are ultimately created. And I certainly want to be an owner in them, as I have.
Okay, do we have anybody else out there who wants to ask a question? You did such a great job, Sean, that everybody's questions have been answered.
Well, good. Well, I'm here for a handful more minutes. If there is any questions, obviously, I appreciate the time, and happy to, set up a call individually if that's, what is requested of the guests here today.
We just had one come in. How does the 1031 work as an exit?
Yeah, no, that's a great question. I think that's what makes this asset of value. So you can a lot of our mineral owners that we buy from are doing 1031s out, right? So the way it would work is if you were an investor in Cedar Ranch, let's just go forward, 4 or 5 years out, we have an exit opportunity that we present to you, Ted. You would then give us you'd have to basically say, hey, I am interested in exiting, which we provide a non-binding LOI. So basically you saying, yes, I want to be part of the exit. At that time, we're going to set up a QI that you would probably choose from, maybe Mark Direct, maybe you have one. That's going to all be kind of in place. Then we'll go to the closing table with the buyer. Your proceeds of that exit will then go to your QI, and then you can redeploy those into another asset. Maybe it's minerals. Montego would naturally have an offering, I would anticipate, that you could consider among all the other opportunities out there.
Hey, anybody else before we end this? Well, I appreciate your time today, Sean. Okay, we got another one in depreciation, recapture, and capital gains.
Yeah, you're gonna protect yourself from that, right? That's why you're gonna want to do the 1031. So you're gonna want to. I mean, you may not have to do it, but yes, yeah, that's right.
He's asking, how does it affect it?
Well, it seems like he might have got it out of that, but maybe not. So kind of expand. I'm not sure, Ted. Did I get your question, Ted? Seems like, he's connecting to audio here. Let's see. Yes,
yeah, he said
says.
yes. Okay. Well, if anybody needs to ask additional questions or you want additional information, Mark at metric-financial.com. Just send me an email and I'll send you the brochure or whatever else you want that we can provide you. Sean, I appreciate your time today. I like to think that you do a really good job of covering oil and gas royalties. It's part of the reason why I think you're our standard bearer for this asset class in this industry. Feel free to contact me, anybody that was on the call, and we can discuss later. And I appreciate everybody's time today.
Thank you, Mark. I appreciate you.
Okay. Hey, have a good one, everybody. Bye.